Hello friends, this is Vijay Bhambwani and I'm back with you again to discuss the weekly market outlook. But before I begin, why do I say that you should trade light on my social media account? Why have I been posting a lot of snapcode windows on my social media account of late? Why am I saying in my daily post market end of the day market updates about statistical beta and the FNO turnover that you should be trading light and beta is spiking? I've recorded a special segment which I will be discussing with you towards the fag end of this video. So please don't go away. This is something that is important. It is also about what is spooking the markets right now and why the markets did what they did last week. So let's plunge right in, and on your screen are the market roundup figures, and as you can see that the Nifty lost 1.22% on a week-on-week basis after logging a new high on Tuesday itself. And this is something that I had said in my video last week, that the possibility of the market rising remains firm and volatility will be high. And what amazing volatility. This is something that I assure you I will be discussing with you in the special segment in the fag end. The Bank Nifty continued to rise on a tear due to the triggers that I have mentioned in my recent videos about Indian bonds being included in global bond indices and an expected pickup in economic activity, opening up of the economy after lockdowns, and generally the recovery expectation of the banks, the guidance that they have been giving lent out the optimism. So oil continued to rise, which you can see in the market roundup statistics, which is part of the reason inflationary fears return to haunt the markets. Bullion rose, which is gold and silver, and this hints of a risk of sentiment possibly, I repeat the word possibly, returning to the markets. Now, what is risk of? Risk of meaning that the ability or the willingness of the market participants to take higher and higher risk is going down, which is why they're running towards the safety of gold and silver. So there is a possibility that the risk appetite of traders to buy financial assets which are highly risky is going down and they are buying bullion. Inflation, of course, is a conducive time for gold and silver to go up, and inflation has been the screaming rage all of last week. If you are connected with me on social media, you will realize that I have been screaming about this factor for many quarters. My contact coordinates come at the end of this video. Please do connect with me to get updates on a daily basis. And I put up a lot of content there which will help you make better decisions. So I've been screaming about inflation, which is basically pushing the prices of bullion higher, and it's lending volatility to currencies, which is in turn helping bullion. Now, the Dixie, the US dollar index against the global basket of currencies fell, which was another saving grace for the markets, because a rising dollar is generally negative for emerging markets, including India. Indian bond yields continued to move north, which is another minor red flag for the markets. Now, last week there were a lot of red flags. I'm going to discuss all of them as we proceed in this video. And the bond yields need to be watched very carefully in the coming week. Coming up on your screen now is the MWPL, which is the market-wide position limits. This is a measure of the overall exposure that the market participants have taken in the week. Now, this continued to rise, although the previous month's highs being tested seems less and less likely. Do remember, we have only 3 more days trading sessions left before expiry on Thursday. So scaling the September highs in terms of MWPL seems unlikely, which means risk appetite may be tapering. Let's watch the next few sessions and see if MWPL does rise, because after Tuesday, I don't think I would give it much of a possibility. The on-screen graphic on your screen right now is the index and stock futures turnover. Do remember, this is a cumulative figure of 3 expiries, which is October, November, and December. And it shows that traded volumes have jumped to their highest both in indices and individual stock futures after 30th September 2021, which means traded volumes are the highest they were in the calendar month of October. Now, that basically shows that trader participation was fairly high in the week gone by during the decline in the markets. Now, this is again another minor red flag. Now, you must connect with me on social media wherein I update these figures on a day-to-day basis. And late in the evening, you can go through all this data. Very simple to understand, very easy. A secondary school student will be able to figure it out. My contact coordinates, as I told you, will come at the fag end of this video. Coming up now is the basis chart. Now, the basis is nothing but the future premium enjoyed over the spot. On a week-on-week basis, the basis of both the indices, Nifty and the Bank Nifty, rose. This is because there was short covering seen at lower levels, and this boosted the futures premium over spot. Do remember, as we come closer to expiry, trades do tend to get squared up. So preferably, I think the shorts were seen squaring up, which is why the futures premium rose. Now, this is again something that I update on my social media accounts every day. Now, friends, we come to the most dependable study that we have from our in-house statistical trading model, the IBEX, which is exclusive, and it's not available anywhere in the free domain. It has stood the test of time. This is the impetus chart. Now, the Nifty has surrendered a substantial portion of the impetus gained in the prior week, which, according to me, is a mild worry. This is another red flag in the data that I have collected in my statistical model for the week gone by. Now, if this reading falls even further for the Nifty, then the bulls may come under pressure in the absolute near term. Do remember, I'm addressing traders here on a week-on-week basis. I'm not talking about your core portfolio. I'm not talking about your deliveries. I'm not talking about your long-term blueprint, etc. We are just talking for absolute short term. Now, the impetus of the Bank Nifty tells me that the index might itself have risen in absolute terms to new highs, but the impetus is flatlining. In the last 3 trading sessions, it's going sideways. Now, like I said in my previous week's videos, ideally, the price and the impetus should rise together. If not, the situation should be watched carefully. Now, this is something again that I will update on my social media accounts as and when required. This is not something that I update every day, but remain assured, if anything that is critical to be updated in terms of impetus, I will do so. Now, let's check the footprint of the various categories of traders in the market to see who is doing what. I first start with the FIIs, who've reduced their index futures longs to 37,993 lots as against 51,721 lots last week. Their stock futures have actually plunged into net shorts of 7,021 lots, whereas last week they were net long of 84,912 lots. Where DIIs are concerned, the domestic investment institutions are concerned, their index short positions have risen to 79,512 lots from previous week 75,892 lots. Where the stock futures shorts are concerned, they remain net shorts, of course. They fell marginally to 12,86,469 lots, which last week was 12,87,052 lots. Where the prop traders are concerned, these prop traders are brokers, own proprietary trades. They are the second best thing to insider trading because these brokers know who's buying what and in what quantity. So the prop traders went net positive in the index futures to 19,735 lots as against net short of 27,085 lots last week. Where their stock futures exposure is concerned, it continued to stagnate and fall to 1,81,628 lots as against last week's 1,91,031 lots. Where retail traders are concerned, let's see what they are doing. They cut their index futures long positions to 21,784 lots from last week's 51,256 lots. Where stock futures are concerned, they actually raised their stakes to 11,11,862 lots from last week's 10,11,109 lots. So the only guys gung-ho are the retail traders. Will they be able to lift the market single-handedly when prop traders and FIIs are actually cutting their long positions? FIIs have actually gone short in net short in stock futures, and the DIIs actually remain short. Will the retail guys manage to do all the heavy lifting alone? I think the coming week or two will be a litmus test of the retail traders. Do also remember that the coming week is special because it is an expiry week, so volatility is likely to go sky high. Friends, let's now go to the Indian 10-year benchmark bond yield, which was a very, very edge of the seat excitement last week because the bond yields pierced the 6.40 threshold briefly and went to 6.42, 6.43 before returning back to 6.35 by the ending of the week. I would suggest you watch 6.50 figure very, very keenly. If the yield starts to stay above the 6.50 mark, bulls may find the going getting a bit slower because the cost of funds will start to get dearer. And this will show immediately on banking stocks and your bank nifty trades. So this is something you need to be absolutely clear about. Even if you don't invest in bonds, for the sake of your individual stock trades, especially banking and bank nifty trades, do keep this indicator on your radar. Now, many commodity exporting countries like Brazil, Russia, Chile, Peru, etc. are raising interest rates, and amongst the big Western countries, the United Kingdom is contemplating following suit in its Bank of England meeting in early November. If it does so, it will be the first major global economy to raise interest rates. Should that occur, expect some cooling off in riskier financial assets. So this is of course something that I'll be keeping on posting on my social media pages. Do connect with me. My contact coordinates will come at the fag end of the video. Also, do remember I have special segments for you in this video. Friends, let's now go to the Dixie, the US dollar index, the US currency benchmark index versus the global basket of currencies, which fell on a week-on-week basis, falling on 3 out of 5 trading sessions. The price has settled near the critical 93.5 level, which is marked by a red dotted line. Do note that I've been advocating watching this threshold since many weeks. Now, the price is below its 25-day exponential moving average, which I told you is appearing simple as an average. It's too simple, but it's a very critical study. It marks approximately 1 month's average holding on cost of a bull, and the Importance of this average is that if long traders see the current market price going below a month's average, they trend to panic and sell out their long positions. So currently the price is below its 25-day exponential moving average, which indicates that the near-term trend is under pressure. I would need a sustained trade above the 94.5 level before expecting that a fresh up move would get triggered. Let's now switch over to the weekly chart. It shows a second consecutive week of decline, but the price is still comfortably above its 25-week exponential moving average, which happens to show a 6 months average holding on cost, which means the medium-term outlook remains positive and for now. Now, last week there was enough negative data on inflation, which politicians worldwide are ironically now admitting that inflation is not transitory, it is here to stay. Those of my viewers who've been in touch with me on social media will instantly recollect that I have been debunking the transitory inflation theory. And here we are being proved right one more time, just that we happen to be ahead of the curve, ahead of the broader markets, but we are going to get there and we are going to be the first guys to hit a home run. Now, also remember that the USD index, the Dixie, also determines trends on bonds, commodity prices, especially bullion and oil, and emerging market equities. So even if you don't trade the US dollar, you should still monitor it because asset classes are married to each other and there is a pull and push impact of one asset class price movement on the other. Now, last week I advocated a range between 94.95 on the upside and 92.95 on the downside, which held perfectly. The coming week is likely to see an estimated, I repeat the word estimated, range between 94.55 on the upside and 92.60 on the downside. Watch this index very keenly in the coming few weeks. Friends, now I come to the Bank Nifty, and this index gained 2.5% last week, clearly outperformed the Nifty 50, which was a net loser on a week-on-week basis. Do remember that the impetus chart had clearly said that the Nifty was relatively weaker as compared to the Bank Nifty. But the impetus can always pick up for the Nifty, so we have to be keeping our ears onto the ground for hearing the market signals earlier than the others. The daily chart on your screen shows the index gaining on 3 out of 5 trading sessions and staying above the 25-day exponential moving average, which, I repeat, indicates approximately a month's average long holding on cost. The last candle looks like an inverted hammer, which is a small, tiny red flag. It gets negated if the price stays above its high at the 40,587 all of next week. Volatility is hitting crescendo levels and that's a concern, so trade extremely carefully here onwards. The weekly chart on your screen shows a bullish candle, though it is smaller than its prior week's candle. The price is at an all-time high, so there is little danger of overhead supply coming from trapped bulls, which is the case if the market falls and then picks up again. Here, there is no trapped bull at higher levels waiting to get out. So overhead supply is unlikely, though profit taking can always come from traders who are in the money. Now the price is above its 25-week exponential moving average, which represents approximately a 6-month average holding on cost. This means that the medium-term outlook also remains positive for now. In the week before last, this index was number 5 on the most volatile list, but it rose 2 notches to number 3. That makes the index trading challenging for retail traders because volatility can see two-way sudden price moves. Last week, I advocated a range between 40,725 on the upside and 37,950 on the downside, which held beautifully well in spite of all that volatility, because the intra-week high was 40,587. We missed the expected high by a margin. Now, the coming week is likely to see an estimated, I repeat the word estimated here, range between 41,700 on the upside and 38,925 on the downside. Now, looking at the higher beta, I wouldn't be surprised if this range was breached in one of the directions. Now, I repeat my advice here at the risk of sounding repetitive. Please continue to trade light, because markets are very, very edgy. They are very nervous, and they are completely emotionally charged and sentiment driven. Do stay on till the end of this video, where I discuss a critical aspect of screen trading on volatility marking, so you can get better in your trades. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 1.22% last week, and it rose on 1 out of 5 trading sessions. And it opened high on Monday, made a new all-time high on Tuesday. On that day itself, it's been on skid row. It's been slipping on each of the 4 days starting on Tuesday. Now, the 4 candles on your screen on the daily chart are telling us a story that is confirmed by the falling impetus that we saw earlier. This is why I've been posting the snapshot window of stocks and even the Nifty on my social media account, and I'm going to give you a brief tutorial on how to read your trading screen and how I've been identifying that volatility has been spiking higher. So, the price remains above its 25-day exponential moving average, which represents approximately a month's average buy price, which means the short-term outlook remains positive, but for now. I will look out for the price and impetus to rise together before venturing a buy for short-term trades. Remember, I'm addressing short-term traders. If you're looking for long-term investment advice, this is not for you. The price is at a critical inflection point where gaps that were left open on the way up, as you can see on the screen, are now getting filled or closed. Now the test for the bulls is whether they can pull prices higher or fail to support the price on declines. Let's now switch to the weekly chart, which shows a bearish candle that has pierced the prior bullish one, though not exactly very deeply enough. That makes follow-up buying action critical to watch out for in the week ahead. The price remains comfortably above its 25-week exponential moving average, which shows approximately 6 months average buy holding price. That means the medium-term outlook is positive for now. I would want a breakout above the weekly high at 18,604 before I would say that all doubts about the bull market have been negated and the bulls are back in the driver's seat. However, on the flip side, a sustained trade below the week's low at 18,035 may see short-term weakness. Remember, I'm talking of short-term traders, not delivery-based investors here. The bullish channel, those 2 parallel trend lines running upwards, remains in place, and the small decline can be anything from a routine correction to a sideways pause. But we'll need to be extremely alert, because all declines initially start with a pause or a small corrective decline. So whether it's going to be a bigger fall or not, we don't know yet, but let's be careful out there. So we'll let the price tell us which way it's headed rather than conjecture and guess. In the week before last, this index was number 12 on the most volatile list, but it fell 5 notches to number 17. Do remember the impetus for the Nifty has fallen. So volatility fell. So it's not a surprise that beta fell. The beta ranking took the Nifty to number 17 from number 12 in the prior week. The weekly range I advocated between 18,800 to 17,875 held. All right. But that was not really a surprise because the intraday ranges were contracted due to lower beta. In the coming week, I expect the estimated range, I repeat the word estimated, range between 18,575 on the upside and 17,650 on the downside. I repeat my cautious advice that you should trade light and stay very sharp because next week the volatility is likely to be heightened by the inflationary and other concerns, monthly expiry, and the coming holidays, because of which traded volumes and open interest might fall. Friends, I now have two more segments to share with you. One is 5 high beta and 5 low beta stocks, and the one special segment that I promised you I will show you some revelatory things about the market. So let's start about the high beta stocks, wherein you take small exposure and wait for large price moves. That list is led by Berger Paints at number 1, number 2 Naveen Fluorine, number 3 Hind Unilever, number 4 Colgate, and number 5 LTI. The low beta, low impetus stocks list is led by Page Industries, number 2 Cub, number 3 Bharat Forge, number 4 Bosch, number 5 Manappuram Finance. Now these are stocks which are low beta, where you take large exposure and wait for small price moves. Why the difference? Because different markets, different volatility periods, and different traders, different mindsets, and therefore different techniques in the market. Friends, do note that volatility changes from hour to hour. Therefore, the hierarchy of names that are in this list can change from day to day, which is why you must connect with me on social media to get day-to-day updates. Now for the last segment, wherein I promised you I want to share a critical update with you. This will also solve your problem about why I have been telling you to be cautious, why there is so much of hey, let's be careful out there, hey, trade small kind of advice coming in from me. Now watch the snapquote windows on your screen. Now these are windows that will come on your trading terminal, on your desktop or your laptop when you highlight a stock or a counter and click on F5. These are best 5 buyers and best 5 sellers. Note the difference between the buyer and the seller, pretty wide. Now this difference is called the spread. Now the wider the spread, the more illiquid the market, which means when it's falling, you give it a little bit of selling pressure and the price will sink like a hot knife goes through butter. The same with a rising market. If it's illiquid, the bid and offer spreads are extremely wide. A little bit of buying and the price simply goes up because there are not too many sellers at various incremental price points. So we don't want an illiquid market. An illiquid market basically is a sign of nervousness. And this strategy applies in both a bullish market and a bearish market. If the market is falling and the spreads are very wide, believe me when I tell you this, the market will fall even more faster. Last week, to my chagrin, to my utter horror, I have seen spreads of 60 and 65 paise on DLF. This is, by the way, not a trade on DLF or the Nifty. This is just a hypothetical study. Of course, the prices are real. You can see from the dates on your snapquote window. This is from the real world. This can't get any more real than what I am showing you right now. All right. But these are not recommendations. You'll have to keep watching the screens continuously like a hawk. Do not take your eyes off the screen. Maybe for this. But other than that, do not ever leave the snap quote window during trading hours. This will tell you where the prices are about to come under pressure or rise suddenly. And remember, the wider the spread, the more money it takes for you to have realized, oh, I made a mistake. I bought at a high. Now let me get out. You'll have to sell at a very a huge spread at a big discount to where you bought from. So the penalty for getting in and getting out of a stock becomes higher. And that is just gross. After this, there will be execution costs, commissions, taxes, brokerage, etc., etc. So friends, last week, the kind of spreads that I saw, I haven't seen in a while, which is what tells me that we are going to be in for highly volatile times. Now, do these spreads mean that the market is about to fall? Hey, I don't know. I don't know. I will let the price tell me. But should you be careful? Absolutely. Absolutely be careful. And now, I want to share with you a new segment that I have started in the last 2 weeks, what we call What's Hot, What's Not. That will again lend credibility to what I just told you about why I think the markets are nervous. If you actually tie all the jigsaw puzzle pieces together, you will understand that my videos are a lot about sense and sensibility, about rationality, and which is why I call it my 360-degree worldview. Now, what's hot? By hot, I mean positive. What can enthuse the market is that India and United Kingdom are seeking cooperation with each other over solar power generation. Do remember that this government has been promoting gigantic solar power plants, and the more we reduce our dependence on fossil fuels, the better it will be for our energy security. So that's a thumbs up. Vaccination is going on in top gear. We've achieved 100 crore vaccine doses. COVID cases are falling, which is another positive. Now, the third thing, which according to me from a commodity trader point of view is good, but not exactly being home yet, because there's a lot of bureaucracy going on between Russia and Germany. I'm talking about the Nord Stream 2 pipeline. The Russians have tested the pipeline with test gas for leakages, etc., and they are satisfied that the pipeline is okay. If the Germans were to give regulatory approval to the Nord Stream 2 pipeline from Russia, the Russians have assured Europe that they can start pumping in gas to the extent of 17.5 billion cubic meters per annum pro rata. Of course, the capacity of each pipeline, and there are twin pipes there, is 55 billion cubic meters. So annually, the Nord Stream can pump out 110 billion cubic meters of gas, of which 17.5 billion cubic meters is ready if only the Germans are willing to take it. OPEC members, Saudi Arabia and Kuwait, have absolutely rejected calls by the global community, especially the global warming and environmental activists, to cut down investments in fossil fuel exploration and drilling of oil. As a matter of fact, the Saudis and the Kuwaitis are talking about increasing oil output capacities, which I think is good in an energy-starved world. I think the markets should take it as a thumbs up. The other thing that can enthuse the market is that the Chinese have managed to cool down coal prices, which you would have seen in the international markets, and they've instructed all coal miners to immediately hike output, which has had a relieving factor. Now, what's not? What can worry the markets? And believe me, these worries have only gotten bigger. That's what's upsetting me. This is what I have been time and again posting on my social media accounts, which I think you should connect with me for. Now, rising oil prices are inflationary, which is something which is why bullion is rising. Bond yields are rising, and like I told you, commodity countries have raised their interest rates. And if England starts, I believe that the stock markets worldwide might get a little bit of the heebie-jeebies. Now, the third point. it's extremely critical. Because of shortage of gas, the fertilizer industry is saying, and you can't make fertilizer without gas. The fertilizer industry is saying there would be a shortage of fertilizer next year, which means there would be a shortage of food next year. Now, food inflation is something I have been screaming about since over 6 quarters on social media. Point number 4, the Food and Agricultural Organization, which is a subsidiary of the United Nations Organization, the UNO, is saying that food inflation in some parts of the world in certain categories might go, hold your breath, as high as 30%. What's bad about food inflation? Food is not something you can do without. So irrespective of the price, you're going to have to buy it. Now, if you're going to buy more and more expensive food, there's less and less money left for something else. So that's going to depress the markets. Now, the OPEC and its fellow OPEC plus members have rejected appeals by USA, by India, and a whole lot of other countries to raise oil output and cut prices. They are saying OPEC cannot help you here. We have no option but to keep prices firm. Now, that's something that the markets will get worried about. And safe haven buying in gold is another factor which is telling me that maybe, just maybe, I'm conjecturing here, early days yet, we've not seen too much of weight of evidence now, which is why I'm going to keep my ears to the ground and listen to the horse hoofs for what's coming next. So, is money coming out of equities and going into bullion? The coming few days will tell us. But is it something that you should sit up in your chair and say, okay, I'm going to take notice of it? Yes, you should. When gold and silver are rising, chances are paper assets might become a little soft. So, hey, let's be careful out there. Friends, if you liked my video, please subscribe to my YouTube channel. Click on the bell icon to receive instant alerts about fresh videos being put up out here. I welcome all your feedback as long as it's proactive, as long as there's a healthy debate going on and we can help each other become better traders. Also, help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. In the description below the video are hyperlinks to my Equity Master YouTube channel, wherein I put up a couple of trading ideas and market-related ideas every week. Do subscribe to my YouTube channel there on Equity Master as well. Also, there is a free trading guide on offer from Equity Master. Hyperlink below the video in the description segment. Do avail of this fantastic offer to become better traders. On this cheerful but cautious note this weekend, I bid goodbye to you. Thank you for your patience. Thank you for watching my video. I wish you have a very, very profitable week. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.